There's a financial maneuver happening right now that would land any private citizen in prison. It's called circular financing, and when corporations do it, regulators shut them down. But when the United States government does it, it's called monetary policy. Here's the uncomfortable truth. The US government is buying its own debt. Not directly, that would be too obvious, but through an elaborate shell game involving the Federal Reserve, primary dealers, and a system so convoluted that most economists can barely explain it without contradicting themselves. And before we dive into this financial rabbit hole, if you appreciate content that pulls back the curtain on how money really works, hit that like button, share this video with someone who needs to understand the game being played with their future, and subscribe to this channel. Because what you're about to learn isn't taught in economics classes for a very good reason. The question isn't whether this system works. The question is, what happens when it stops working? The debt machine. Let's start with a simple premise. The United States government spends more money than it collects in taxes. This isn't a political statement. It's arithmetic that's been true for decades, regardless of which party controls Congress or the White House. In 2023 alone, the federal government spent approximately $6.1 trillion while collecting roughly $4.4 trillion in revenue. That's a deficit of $1.7 trillion. And this isn't an anomaly. It's the norm. The last time the U.S. ran a budget surplus was in 2001, over 2 decades ago. So where does that missing money come from? The government borrows it by issuing Treasury bonds, notes, and bills, collectively known as Treasury securities. These are essentially IOUs that promise to pay back the borrowed amount plus interest at a future date. Now, in a normal world, the government would sell these bonds to investors, pension funds, foreign governments, insurance companies, and individual savers looking for a safe place to park their money. And to some extent, that still happens. China holds about $850 billion in U.S. treasuries. Japan holds over $1 trillion. Mutual funds and pension funds hold trillions more. But here's where it gets interesting. The single largest holder of U.S. government debt isn't China. It isn't Japan. It isn't even American pension funds. It's the Federal Reserve, the U.S. central bank. As of 2024, the Fed holds over $4.8 trillion in Treasury securities on its balance sheet. That's roughly 17% of all publicly held U.S. debt. Think about that for a moment. The institution that prints U.S. dollars is also the largest single purchaser of U.S. government debt. The left hand is lending to the right hand, and both hands belong to the same body. The mechanics of the shell game. Now, before you accuse me of conspiracy theorizing, let me be clear. The Federal Reserve doesn't directly buy bonds at Treasury auctions. That would be too transparent, and it's actually prohibited by law in most circumstances. Instead, the system operates through an intermediary structure designed to create the appearance of market-based transactions. Here's how the trick actually works. Step 1. The U.S. Treasury announces it needs to borrow money and schedules a bond auction. These auctions happen regularly, sometimes weekly for short-term bills, monthly for longer-term notes and bonds. Step 2. A select group of financial institutions called primary dealers, major banks like JPMorgan Chase, Goldman Sachs, and Citigroup, are required to bid at these auctions. They purchase the Treasury securities using their own capital or borrowed funds. Step 3. Shortly after the auction, the Federal Reserve announces it's conducting open market operations, a sanitized term for buying bonds in the secondary market. And who does the Fed buy these bonds from? The same primary dealers who just purchased them at auction. The primary dealers make a small profit on the transaction, a few basis points here and there, but the real magic happens at the Fed. When the Federal Reserve purchases these bonds, it doesn't use tax revenue or existing funds. It simply credits the seller's account with newly created digital dollars. Money appears out of thin air, backed by nothing more than the authority to create it. This process has a name, quantitative easing, or QE. It sounds technical and sophisticated, but strip away the jargon and you're looking at something remarkably simple. The government is financing its spending by creating new money. From 2008 to 2014, during the financial crisis and its aftermath, the Fed expanded its balance sheet from about $870 billion to $4.5 trillion through these purchases. Then came the COVID-19 pandemic, and the Fed went into overdrive, ballooning its holdings to nearly $9 trillion by 2022. To put that in perspective, the Federal Reserve created more new money in the 2 years from 2020 to 2022 than in the entire previous history of the institution dating back to 1913. Why this isn't normal borrowing? At this point, some defenders of the system will argue that what I'm describing is perfectly normal central banking operations. They'll tell you this is just how modern monetary systems function, and that there's nothing sinister about it. But let's examine what actually happens in a traditional borrowing relationship versus what happens with government debt bought by its own central bank. In traditional borrowing, there's a genuine transfer of purchasing power. When you take out a mortgage, the bank lends you money that came from depositors' savings. Those depositors temporarily gave up their ability to spend that money so you could buy a house. There's a real economic trade-off. When a foreign government or pension fund buys U.S. Treasury bonds, the same principle applies. They're using money they already earned and choosing to lend it to the U.S. government instead of spending it on something else or investing it elsewhere. But when the Federal Reserve buys government bonds with newly created money, no one gave up anything. No one made a sacrifice. No real economic resources changed hands. The Fed simply conjured the money into existence through computer keystrokes. In effect, this means the government debt held by the Federal Reserve isn't really debt in any meaningful sense. There's no external creditor to repay. The interest payments on Fed-held bonds flow back to the Treasury as Fed profits anyway, a closed loop where money circulates from one government pocket to another. Imagine if you could write yourself a check, deposit it in your own bank account, and have both the bank and the account under your control. That's essentially what's happening here, just dressed up in sophisticated financial terminology, the historical precedent. This isn't the first time a government has discovered it can finance spending by having its central bank buy government debt. The strategy has been tried repeatedly throughout history, and the results follow a remarkably consistent pattern. In Weimar Germany after World War I, the Reichsbank purchased enormous quantities of government bonds to finance war reparations and domestic spending. The result? Hyperinflation that destroyed the savings of the middle class and required people to carry wheelbarrows of cash to buy bread. In Zimbabwe in the 2000s, the Reserve Bank of Zimbabwe printed money to finance government expenditures. At the peak of the crisis, inflation reached 89.7 sextillion% per month. The currency became so worthless that Zimbabwe eventually abandoned it entirely. More recently, Venezuela's central bank financed government spending through money creation, contributing to inflation that exceeded 1,000% by 2018. The bolivar lost virtually all its value, and millions of Venezuelans fled the country as their savings evaporated. The defenders of current U.S. policy will quickly point out that America isn't Zimbabwe or Weimar Germany. The U.S. dollar is the world's reserve currency. U.S. Treasury bonds are considered the safest asset in global finance. The American economy is diverse, productive, and innovative. All of this is true, but it's also true that every government that embarked on debt monetization believed they were different, believed they could control the process, believed they would stop before it went too far. The critical question isn't whether the U.S. is currently experiencing hyperinflation. It's not. The question is whether the mechanisms now in place could lead there if political incentives push in that direction. The inflation tax. When the Federal Reserve creates new money to buy government bonds, that money doesn't disappear into a void. It enters the economy, increasing the total supply of dollars chasing the same amount of goods and services. Basic economics tells us what happens next. Prices rise. This is inflation, and it functions as an invisible tax on everyone holding dollars. Think about what happened from 2020 to 2023. The Fed massively expanded its balance sheet, and the federal government ran enormous deficits financed partially through this mechanism. Then inflation surged to levels not seen in 4 decades, peaking at 9.1% in June 2022. Was the Fed's bond buying the only cause of this inflation? No, supply chain disruptions, energy prices, and other factors played roles. But to claim that creating trillions of new dollars had no effect on prices requires ignoring centuries of economic history and basic logic. The insidious aspect of inflation as a tax is that it's not voted on by Congress. It doesn't appear as a line item on your tax return. It simply erodes the purchasing power of your savings, your wages, and your fixed income investments while politicians and central bankers claim they're doing everything possible to help you. If you had $100,000 in savings in 2020 and inflation averaged 5% per year for 4 years, you'd need about $122,000 in 2024 to have the same purchasing power. That $22,000 difference, that's the inflation tax you paid, transferred to the government through the mechanism of debt monetization and devalued currency. The cruelest part is who pays this tax most heavily. The wealthy hold assets, stocks, real estate, businesses that often appreciate during inflationary periods. But working-class families living paycheck to paycheck, retirees on fixed incomes, and savers who responsibly kept their money in cash, they're devastated by inflation, the addiction problem. Once a government discovers it can finance spending by having its central bank buy debt, stopping becomes extraordinarily difficult. The addiction metaphor is apt because the mechanism creates the same cycle of dependency and escalation. Consider the political incentives. Politicians can promise voters new programs and benefits without the political cost of raising taxes or cutting other spending. Deficits can be blamed on previous administrations or economic circumstances beyond their control, and by the time inflation emerges as a consequence, the political actors who created the problem may be out of office. Meanwhile, the immediate beneficiaries of government spending, whether defense contractors, social program recipients, or corporate subsidy receivers, become powerful constituencies opposing any reduction in the flow of money. The Federal Reserve faces its own pressures. When the central bank tries to reduce its balance sheet or stop buying bonds, interest rates rise. Higher interest rates mean higher government borrowing costs. They also mean potential recessions, stock market declines, and political pressure on the Fed to reverse course. We saw this dynamic play out in 2018-2019 when the Fed attempted to normalize its balance sheet after years of QE. Markets threw a tantrum, the economy showed signs of weakening, and the Fed quickly pivoted back to expansion before the pandemic provided cover for even more aggressive intervention. Then, in 2022, facing undeniable inflation, the Fed began raising interest rates and reducing its bond holdings. But the reduction has been glacial. The balance sheet remains more than double its pre-2020 size. And at the first sign of stress in the banking system in early 2023, the Fed created new lending facilities that effectively pumped more liquidity back into the system. The addiction model predicts that each cycle of monetary expansion will be larger than the last, and that withdrawal attempts will be abandoned at lower and lower pain thresholds. So far, this prediction has proven accurate. The endgame scenarios. So where does this end? There are several possible paths, none of them particularly comfortable. Scenario 1. The system continues indefinitely. Modern monetary theory advocates argue this is possible, that a government with its own currency can continue spending without constraint as long as inflation remains manageable. In this view, the bond trick isn't a trick at all, but simply how sovereign monetary systems should operate. The problem with this scenario is that it requires permanent confidence in the currency and in government institutions. It requires that markets never lose faith in treasury bonds as safe assets. It requires that foreign governments continue accepting dollars as reserves. And it requires that inflation remain tame despite unlimited money creation, a requirement that historical evidence suggests is unrealistic over long time horizons. Scenario 2. A crisis of confidence triggers a bond market collapse. If investors begin doubting the value of Treasury securities or the future purchasing power of dollars, they could demand much higher interest rates to hold U.S. debt. With $34 trillion in outstanding debt, and growing, even a modest increase in average interest rates could make debt service costs unsustainable, forcing even more money creation and potentially spiraling into a currency crisis. Scenario 3. A deliberate default or restructuring. The U.S. government could theoretically declare it will no longer fully honor its debt obligations, paying back bondholders with devalued dollars or extending maturity dates. This would be economically devastating and politically almost unthinkable, but it's not without historical precedent. Roosevelt's 1933 gold confiscation effectively constituted a partial default on government obligations. Scenario 4. Financial repression becomes permanent. The government could use regulations and political pressure to force financial institutions, pension funds, and even individuals to hold treasury bonds at below-market interest rates. This hidden tax would transfer wealth from savers and investors to the government while maintaining the appearance of a functioning bond market. Scenario 5. Inflation remains elevated but below crisis levels, slowly eroding the real value of the debt. This is perhaps the most likely outcome in the medium term. Inflation rates of 4 to 6% that allow the government to inflate away its debt burden over decades while maintaining enough economic function to avoid collapse. Each of these scenarios represents a different way that the bond trick eventually resolves itself. What none of them offer is a painless return to fiscal sustainability and sound money. What this means for you. You might be wondering why any of this matters to your daily life. The answer is that this system affects virtually every financial decision you make. Your savings are being slowly devalued through the inflation tax. The interest rates on your savings accounts and bonds are artificially suppressed by Fed purchases, keeping rates below where free markets would set them. Asset prices, from stocks to real estate, are distorted by the flood of newly created money-seeking returns, creating bubbles that eventually burst. When you plan for retirement, the calculations you make about how much you need to save are built on assumptions about currency stability that may not hold. When you take out a mortgage or student loans, you're making bets about future income and inflation rates in an economy increasingly driven by monetary manipulation rather than real productivity. The middle class, in particular, bears the brunt of this system. The poor have little to lose. The wealthy can protect themselves with inflation-hedged assets and access to financial strategies unavailable to ordinary people. But the middle class, those who saved, worked hard, and played by the rules, watch their purchasing power slowly drain away. Understanding the bond trick doesn't give you a magic solution, but it does change how you should think about financial planning. It suggests holding some assets that perform well during inflation: real estate, commodities, inflation-protected securities, perhaps even a small allocation to cryptocurrencies or precious metals. More fundamentally, it means recognizing that the financial system is not a neutral playing field, operating according to immutable economic laws. It's a constructed system operated by human institutions with incentives that may not align with your interests. The United States government is buying its own debt through an elaborate mechanism designed to obscure what's really happening. The Federal Reserve creates new money, uses it to purchase treasury bonds, and in doing so finances government spending without the political pain of taxes or the economic discipline of genuine market borrowing. This trick has allowed unprecedented levels of government spending, helped paper over financial crises, and delayed the day of reckoning for fiscal irresponsibility. But it comes at a cost. The slow debasement of the currency, the inflation tax on savers, and the buildup of imbalances that will eventually demand correction. The truly disturbing part isn't that this is happening. It's that so few people understand it, and those who do benefit from the system have every incentive to keep it running for as long as possible, regardless of the long-term consequences. History offers a clear lesson. Governments that finance spending by having their central banks buy their debt eventually face a crisis. The only question is what form that crisis takes and when it arrives. You can't single-handedly stop this machine, but you can protect yourself, educate yourself, and make decisions with the understanding that the rules of the game aren't what they taught you in school. Because in the end, the bond trick isn't really about bonds at all. It's about power. The power to create money, to distribute resources without democratic accountability, and to impose costs on future generations while reaping benefits today. And that's a trick that continues until it doesn't.